computers have become a disadvantage over the year because we have now so much computer time available. In my little phone, there is more computer time than in the big computer we had in our office in the early 90s. And if you have no clear idea and you test it anyway, you can do over and over testing. Within 5 minutes, you can do long calculation. And you very quickly end up into some kind of historical optimization thing instead of having a good idea.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kaastrup-Larsen.
Hey everyone, and welcome to another edition of Top Traders Unplugged, where today Alan Dunn and I are joined by Harold de Boer, Managing Director at Transtrend, as part of our mini-series focusing on the one investment strategy that beat everything else in 2022, namely trend following and managed futures more broadly. First off, Hal, it's great to have you back on the podcast. Thanks so much for joining us today. We really have been looking forward to our conversation. How are you doing? I hope you had a good start to the new year.
We had a good start, yes. Absolutely.
Yeah, and for hopefully some relaxed downtime over the holidays.
Well, somehow the flu decided that it was time for me.
Sorry to hear
so
that.
I think that's... So I have not done any Christmas visits or whatsoever.
No, okay, fair enough. Now, before we dive into all of the different topics we're going to discuss today, I would like to set the stage for our conversation so that the audience knows a little bit about your firm's background. So perhaps you could share a few highlights about what the type of strategies that you focus on and maybe where the business stands heading into 2023.
Transtrend, we started off as a research project within a cranes trading firm, physical commodity trading. So with clearly a agricultural background. Within that firm, the idea was that there were funds making money in what they considered to be their markets. So they thought if these funds are making money in these futures markets, then we should do that ourselves. That became a research project in which initially the people behind it thought we would only trade commodity futures. But we decided to go into these dangerous things like financial markets and stock markets and currency markets as well. And soon found out that trend following was the best way to do it. And to do trend following really well, you have to do it in a diversified way, so not only in the commodity markets. So that's our background, and that's what we are still doing.
Fantastic, good stuff. Now, in our conversation today, Alan and I have created a long list of topics that we often sort of get asked about and that we find interesting. But maybe we won't have time to cover all of them, so we'll kind of pick and choose as we go along. But why don't you, Alan, kick it off with the first topic that we wanted to speak about?
Great, thanks, Niels. Good afternoon, Harold. Yeah, it's interesting. You touched on how I guess you guys started off, with a research mindset, looking at the markets. The first topic I wanted to kind of get into is the investment philosophy, which I guess was informed by that research. How, at a high level, how would you describe the investment philosophy of Transtrend?
Yeah, we've been discussing that a lot of time because initially the whole idea was we found out that the trend following way turned out to be the best way to do it. We also found out that all the conventions about trend following that were there in those years were the ones that should not be applied. So we had to be trend following without embracing the conventions. And I think that is generally true for any good investment that will continue to do well. Be careful that you don't embrace conventions. And it's something very typical with human beings that we so much like conventions. And if it's not the managers ourselves, it's of course also the allocators. It's not for nothing that most allocators allocate to traditional investments or investment styles that are highly correlated with it. They like to use consultants, and consultants like to test with standards, and the standards are always the conventions. And money is to be made by not sticking to the convention, but by doing something different. And that's a constant challenge. The constant challenge over now more than 30 years is to beware that we don't become a new convention. And that's also something that has been hitting the industry many times. That the industry became a new convention, and then the CTA industry as a whole did not perform well. If there's no convention, we do well.
Sorry to butt in here. I know Alan has a few other questions, but I'm just curious on that particular point. Can you give an example of what you saw back then? Because you've been there for decades. What did you see back then trend followers do, and how did you want to make it different? I just want to understand that.
Oh, there's many things. One of them, I know we very soon found out that one of these rules that you should always have a stop in. You should always have a stop in the market. We soon found out that you should never use a stop. And we have never done it. And in the beginning, that was really working against us by getting clients, because clients heard, no, CTAs is about stops. So we once were at a conference and some people were talking and they didn't realize that we could hear them. And they say, well, those two people are from Transtrend. Yeah, they are good, said one of them. And the other one said, yes, but they don't use stops. That's bad. Yes, that's bad. And that's typical how it functions. And if you just look at the industry in those years, the first toppers, of course, that's probably is of course the turtles. And the turtles became very successful. And that was, of course, the idea there was that they would all be doing the same thing. They have been trained the same thing and they would become successful. I still like the conversations of Jerry often in this program. And he is, of course, one of these original turtles, and his track record is great. Who also has a great track record is Eckert, who's, of course, one of the ones teaching the turtles. And they're doing complete different things. And they're both doing well. If you look at the first years that CTAs as a group did very well was in 2001, 2002, and there was this internet bubble collapsing, and the CTAs did very, very well. But the turtles weren't the best performing one in those years. And even a few of those turtles didn't survive that period. I think John Henry wasn't a turtle, but was also in that area, and that kind of CTA didn't survive that area, had been very successful before that. If all that money that had been in trend following CTAs in those years would have been so very close to the turtle strategy, do you believe it would have been doing well?
Well, some of them are still doing well, I guess.
Now, if so much money is really doing exactly the same thing, it's never going to be a success. So the turtles continue to be a success because all these new entrances, which really grew from Europe, had some different ideas and different philosophies. And that's why the industry as a whole did do well. We can only do well when we do different things. And yet we have this strange thing of, but if we... I like the discussions with Jerry, for instance. He said, but what Transtrend is doing is not good. Yes, but it's not. It's good because we do something different than Jerry. And Jerry does something different than we do. And that's why we together can do well. And when investors start to do alike things, which is very strange for an alternative investor to do all the things the same, because, again, we should be non-conventional. But yet, we like to embrace conventions. And the turtles is a convention. And they did do well, and the ones that did best were the ones that were constantly evolving and adapting. And that's why Jerry is doing something completely different than Eckert, and the other remaining turtles are doing different things as well. Part of them are still doing very well. But that's typical something that happens. And
yeah. So is it fair to say then, I mean, it sounds like you share a similar philosophy in some respects. Obviously, that trend following is at the heart of what you do. So there's a common belief that presumably that markets trend over time for various reasons, but equally there's a different philosophy around. Is it around would you say it's around execution or risk management or around the need to be constantly evolving, or how would you describe that difference?
It's somewhat comparable with religions. I'm Christian, and Christianity is about. In fact, it's only about one thing. It's about love. But that's very complicated. So many people make rules. The 10 Commandments and many more rules, and they can be. You have to wear the same clothes, or you have to go to the church on Sunday, or you have to do a prayer before you eat, or you can make many rules. And the nice thing is, the ones that are essentially the weakest believers are hiding the most behind the rules, and the ones that are less uncertain don't so much about the rule, but know about the principles. The philosophy, the idea with Christianity is love. Well, with trading, it's not about love, but it's about something else. But it's not about
the love of the
rules.
markets.
And that, of course, is a type of love, and being enthusiastic about it and see what's happening and understand that markets are constantly changing. And the nice thing about these markets is that they are constantly changing, and they are not a constant, and the world is changing, and changing markets are part of it. And if the world isn't changing anymore, there wouldn't be any trend. So enjoy the ride and enjoy being part of a big change. But this change and profiting from it is going against. We have a philosophy, we have a rule, and we stick to the rule. But you cannot have that same rule. And of course, all of us changed dramatically. All the turtle trading was, of course, done on a trading floor, with people running to bring the orders in. Now, no one does that anymore. I hope at least, because they will be somewhat feeling alone on that exchange floor. So the world is changing, and we adapt, and we all should adapt. And the ones that dare to deviate the most are the ones that will be ahead in adapting, and are the ones ahead in finding new directions. And CTAs were doing well because they were ahead, and turtles were ahead, and then there came a new sort of CTAs, a group of CTAs growing from Europe that took some other directions, and they were very successful as well. And then we had what some people call the CTA winter, let's say the whole 2010s, and we are very good in saying that QE was the excuse, or all kind of other excuses. No, it's not. It's a cheap excuse, but the real excuse is that we too much started to become a sector. And for commercial reasons, that's completely understandable. Because people, most investors ultimately don't want something that is different. They want to have a rule. The top down, they first allocate to a style and then to a manager. So if you are not a style, you do not get any allocation. Okay, it has to be a style. As soon as it is a style, investors are afraid for deviation from the style, deviation from the index. The thing that they typically should embrace is the one they are most afraid for. Any investor should say more dispersion is good. It brings me more diversification, but at the same time they are afraid for it. And that's a concept. So if you want to sell the most short term, you have to make choices that are very good. You have to. People don't want to have non-conventional things because that have to be explained. It is scary. In essence, most investors want alternative investments to do everything the same as the standard investment managers, but only have the returns on different moments. Yeah, but that doesn't work. The alternative investments come from making different choices.
But why do you think that contributed to that kind of tough period? Was it that, I don't follow, how did the kind of evolution that everybody became more similar result in that kind of period, challenging period from a performance perspective?
If markets, just like nature, require biodiversity. Again, if all the turtles would have, if all of us would have done the same as the turtles in the 2001-2002 period, we wouldn't have made that much money. You can only have large size in the market when you are doing different things at different moments. If everyone is buying at the same time, it has a huge market impact. And that has been completely neglected in this whole period in the 2010s. I think the most extreme example of that has been AQR. They have been making a lot of story with that theory, that demystifying managed future story. Somehow in our industry we don't like criticizing other managers, but the nice thing with that story is, what they essentially said is, look, all these managers that have been doing trend, we can do the same thing with lower costs, and then we will be better than them. That's the story they did, and it was doing very well. And the storyline was, it's just trend, and we can do the same thing. And they didn't do it only with trend; they did it the same story with other strategies as well. If they do any investment style, they say it's just the same thing. What they really did, the only really new thing about this, what they were doing, was that they were selling hypothetical returns. And we've always seen hypothetical returns being better than real returns. And instead of saying, well, it's hypothetical, so the only thing that's not hypothetical about it is that it is hypothetical returns. No, it's instead they said it's because of the lower costs. What they were completely neglecting, and this directly, you can read it in the paper, is market impact. They assumed a world without market impact. Well, in a world without market impact, yes, you can have indefinite number of investors all doing the same thing because it has no impact. But when investors do all the same at the same moment and they assume no market impact, the market impact will be gigantic and there will be no returns and the markets don't function. So this whole idea, you could see that it commercially functioned great. I don't think there's ever been a CTA that has attracted so much funds in so short term as AQR did with this trend program of them. But they also proved that they were completely wrong, very consistently and very convincingly, because they were doing bad and they underperformed what you can expect when everything is doing the same thing. So what happened in this whole winter, in the CTA winter, all CTAs started to make different choices again. It was the best thing that could happen to the industry. All CTAs made different choices. Winton completely got away from trend following, but all of us made different changes. So we became less the same again. And what happens? The dispersion between CTA performances is large again, as it should be. And we have had 2 great years. And some of us did do very good in this year, and let's say 2022, that's already last year, of course, now. And others did do very good in 2021. But the whole industry together did do well by doing different things at different moments. And it's just because not all do the same thing again. The story is you have to adapt, you have to change, and you have to make different choices. And that's something that we should embrace.
Maybe before moving on to the next bit, I mean, could you give us a sense on some of those choices that Transtrend have made over the years in terms of that drive to be unconventional and differentiated?
The largest changes, we have, of course, over time make the choices that others didn't make. We've always been making a lot of synthetic markets, so not only outright market we trade, also a lot of synthetic markets. We have chosen a clear direction in which we are not so much looking at a system applied on one market, but really look at it from a portfolio perspective. Diversification is the key element of it. So we constantly start to look at it from a diversification angle instead of from just these few markets. And if you really concentrate on that, you make different choices. Instead of saying cut your losses, which is typical thing that you do when you look at an individual market, on a portfolio level, that is different, because if the loss in one market is compensated by a profit in another market, which is coming from the same market move, there's nothing going on. Look at last March, for instance, when Russia invaded Ukraine. We, of course, were not pre-informed by Putin that he was going to do something like that. Stupid man, he forgot to call us. But we had a diversified portfolio. One of the leading themes in that period was already yield rising. And central banks that were leading by rising their yields, their currencies were stronger. This included the Eastern European currencies. Not Austria, Poland, Hungary, Czechoslovakia, Czechia. It's not Czechoslovakia anymore. Czechia. So the Czech Republic, that's what you call it, yes. And of course, when Russia invaded Ukraine, these long positions in these currencies were losing largely. But for us, that wasn't a problem at all. because at the same time we had long positions in lots of commodity markets and they were growing largely. So we could, as an idiot, trying to get out of these Eastern European currencies by selling them at the moment that everyone wanted to sell them and cut your losses and so on. But we just look at it at portfolio level and we say, hey, we have a nice diversified portfolio. Something extreme is happening. It leads to profits in some markets and losses in other markets. Great. As a total, we make a profit and there's no reason for us to do something. This is when you look at it from a portfolio level instead of individual market level. And by doing that, we can better take advantage of being diversified instead of just trading individual markets. But your whole operation has to be set up like that. If you have somewhere an energy markets team and somewhere else a stock markets team and somewhere else a currency markets team, the currency markets team would be thinking in this case, okay, we're losing a lot of money, we should do something. But if it's one program with one team, you are not distracted to that kind of local solving of local problems that are no problem for the portfolio as a whole. So that's one of these elements. Look at it from a portfolio perspective. And that's why we're doing all kinds of changes and all kinds of choices we make.
Now, I don't want to get into the sort of the detailed debate between AQR and your approach, but I do want to bring up something that Cliff Asness wrote during 2022, and I think it is an interesting and I think it is a relevant point, because during this period of lower than average returns, which, by the way, could also just be a function of the fact that central banks had it very easy in keeping things stable with fewer trends, etc., etc. There definitely was this tendency for managers to do more than just trend in their strategy to compensate for lack of trend return. So I think he wrote a paper that basically argued that maybe we have become too concerned about the Sharpe ratio, and this is not his words, this is kind of my memory of it, and we add these non-trend components, but it also means we're kind of losing the ability to really deliver strong returns when the trends come back. And actually, in fairness, you can say that particular firm delivered very strong returns when trends came back in 2022. But more broadly, not just about their strategy, but more broadly speaking, what are your thoughts? What are your observation about this temptation we've seen, where perhaps some managers have gone more to the, say, call it trend following plus type strategy rather than just core trend?
Well, you refer to the recent data of managed futures. The storyline in that paper of them is that others in the industry changed and they sticked on to their strategy. They didn't change. And that's why they did do well in 2022. The fact is, they have a Morningstar rating on their program. And they were downgraded in 2021 or 2020. And that downgrading was not because of performance. It was for only one reason that Morningstar wrote. Because AQR had changed their program. That's why they got downgraded. They forgot to mention this in this article they wrote.
Yeah, so but change AQR, doesn't mean...
change is good.
Okay.
Change is good. I like change. Yeah. But then don't write a story in which you kind of tell that others are changing and you didn't, because they did as well, and that's good. But I welcome that change. I would have liked them writing what they changed and why that resulted in doing so well in 2022, and also there was excellent trends in 2021 as well, and they didn't perform in that year. So it would be more fair to say, look, hey, we make some choices like any CTAs make choices, and the ones we make lead to not performing in 2021 and doing very well in 2022. And choices others make lead to different outcomes in different periods. But the story in itself is not complete there. There's a few things that in that story that I would say that wouldn't pass our compliance department.
No, but I don't want to really make it about them and you. I want to make it more broadly about the industry if we can, because the thing is, I think it all stems deep down from what we believe investors want, right? And investors don't like these periods of no or low or negative performance. And then to make it up in a year like 2022, they obviously prefer steadiness, consistency, and all of that stuff, which is very hard to deliver in a pure trend following package. I think we all know that. So it sounds like you've not deviated from trend. Obviously, I work for a firm that has the same view, but there certainly has been a tendency in our industry to try and smooth things out a little bit, if I can put it that way.
Yeah, what is much more relevant is what kind of techniques do you use when you're doing your research? We've had a sustained period in which interest rates were low and coming down. And if you do all kind of optimization techniques, whether in determining how much to be allocating to which markets or what kind of techniques to use, another way, and you have done that over the years, let's say after 2008, then you will have ended up in something that was doing very well as long as the interest rate was coming down and interest rates were low. And when we get then we have really got a few changes. One of them is there was a pandemic that we had not seen for long enough to be out of the testing period for all investment managers. That doesn't only hold for CTAs, it holds for all investment strategies. All of them that have been done really too much optimization did bad in the pandemic and did bad, were vulnerable when the interest rate started to rise. If you have a more strategy that is less optimized, and that also holds for the very classical CTAs, even the turtle type of CTAs, they have been doing very well the last few years because there was no optimization to a short-term period in it. And others that have too much optimized will have had the difficulties. That has nothing to do again with CTAs. It holds for all investment styles. A quantitative, Volkel, what do you call it in English? A pitfall. That's the English word. It's a quantitative pitfall. You take a certain history and you optimize based on that, and you forget that things that haven't happened in that period can hurt the portfolio a lot later on. So I think that's much more an explanation for what's happening and why ones are doing better and others are not doing better. One of these elements, for instance, is commodities. If you have been optimizing the last few years, the last decades, commodities, the performance in commodities markets tended to be less good than in financial markets, in bonds and so on. So the CTAs that traded much more interest rate instruments and much less commodities have not been doing good. Also not in 2020, even not in 2021. So the CTAs that have zero return in 2021 will most likely not have been trading a lot of commodities, but did trade a lot of interest rate instruments. And those same interest rate instruments did very well in 2022, and that's why they did a lot better this year. That's the number one explanation there. But why did many CTAs, or even we often think that CTAs make a choice, and then we compare with an index. That's also what EQR did in its paper. They forgot that the constitution of the index is changing. There was a time that AQR was not in, and there was a time that AQR was in. And there was a time that, these traditional CTAs that were more the turtle type CTAs, let's say, are not in anymore, but were in the past. So if you say the index is changing, it's not because the managers in the index are doing different things. No, there's different managers in the index with a different style. And which managers are in? The ones that have been getting most funds. Why did they get most funds? The performance was best. Why was the performance best? Well, they did less commodities and more financial markets. So that's why the industry as a whole, without any one of them changing, did more financial markets and less commodities. That's how an index works.
Exactly. I mean, it's a good point about the fact that the index really does change in terms of constituents. And why don't you dig into some of the research topics you wanted to bring up?
Yeah, I mean, maybe before, just to close out on that, it might be, I mean, I think what Harold was saying, obviously you could maybe pick some holes in the paper, but it did raise that general point about, like, what is the objective for CJs and trend program in general? Is it just absolute return, or is it absolute return plus crisis alpha, to use that expression? Or is it absolute return plus crisis alpha plus mitigating drawdowns? Because Harold, you're talking about the choices, but presumably the choices you make are determined by what your objective is and what you're trying to achieve with the portfolio. So, I mean, from your perspective, are you developing a program in Transtrend that's purely just focused on absolute return, or is it absolute return plus one eye on those two other factors?
It's a little bit linked because one thing what we clearly don't want to bring is an index return. You also have CTAs that want to bring the CTA index, which is a stupid thing because there's no CTA index. The index of CTAs is the average of all the different CTAs. It's like there would be some kind of pet average, and you want to become that pet that is doing barking and at the same time catches the mouse and so on. That doesn't work. So CTAs, there's different animals, and they together form an index. The performance of them together is an index. Don't try to bring that index performance, but do well, and if all of us do well, the index is doing well. So that's number one thing. Don't try to bring an index performance, but bring absolute returns, and really absolute returns. If you do that, and if you don't want to fall in the trap by doing the same thing as the other persons or the other investors at the same moment, you have to differentiate somehow, and differentiating can bring returns, and they can also be lower correlated. So looking for absolute returns, trying to do so in doing things that others are not doing, is aimed at bringing good absolute returns, but very likely leads to non-correlated or low correlated, or at least not linear correlated returns. So, and that's what exactly we are doing. We never make a choice of say, hey, we want to do this because that will be good for our tracking error, or high tracking error, or low tracking error, or for correlation purposes or whatsoever. No, we do something because we think what's the best thing to do, to invest. Any kind of other limitation you bring in, they sometimes sound well. This is constantly demand from allocators that want something that is, let's say, we had it also. There was demand for styles that would be doing well if the interest rates would come down and if stocks would be coming down, but it should not be standard CTA because it didn't do so well. Well, we've had now this period of 2 years that CTAs have been doing very well, and I don't think any of these alternative, especially designed for that, some kind of amendment of a real program has done better in that respect. So it's just concentrate on what you should be concentrating on. This is profiting from the good trends that are there in the market, and make sure you do so in a way that it differentiates.
Yeah, you touched on some of the pitfalls you mentioned in terms of the research process, and that example of optimizing a program based on maybe the last 12, 15 years or so, kind of the post-financial crisis era. And obviously that makes a lot of sense in terms of one of the things to kind of avoid as part of research process. What are the other big things that you think, when you're thinking about developing systems or reevaluating systems, how do you think about that? I mean, how do you avoid overfitting to any particular environment? Is about just using very long time series, or and then how do you at the same time balance that with kind of adapting to kind of changed market environments?
By not being led by computers. That's when we started, computers were something pretty new. And using computers and using trends, because trends was, of course, without computers was much more difficult. We still had these charts in our office in which we every day wrote a new price added to it, and the charts become longer and longer. But of course, with computers, you don't have to do that. That can be done much more efficiently. And the type of trend techniques being used with computers available, of course, also has changed than without. Lines were logical to do when you have no computer available, but all kind of moving average type of things works much easier with a computer. So it's logical that it's changed like that. But computers were something that was an advantage. But computers have become a disadvantage over the year, because we have now so much computer time available. In my little phone, there is more computer time than in the big computer we had in our office in the early 90s. And if you have no clear idea and you test it anyway, you can do over and over testing. Within 5 minutes, you can do long calculation. And you very quickly end up into some kind of historical optimization thing instead of having a good idea. And later on, you say that you have an idea. When we started, a complete simulation of the things we had in mind took us 1 week. So there was no room, computer-wise, there was no room for all kinds of historical optimizations. And that has really become a subject over the years because the storyline, and this is again what the CTA is doing and what they're expected to do, the storyline had become, and even we also sold it that way, it's not people doing it, it's the computers doing it. And so the only thing that people that started to work in this industry were probably thinking, the only thing we have to do is to use computers. We don't have to use our brains. We just can use computers. We don't have to have a vision about markets, no view on markets. No, we can just calculate, optimize, and then it becomes completely empty. And the only way to deal with all kinds of situations that you have not seen before is based on intuition or understanding, real understanding what can happen. And be prepared for that. And by having more computers available, the pitfall is that you don't think you need that, but you still need it. So we have to be more selective over years on people, and especially when they are very good in using computers, you have to be careful. Okay, but have you been now doing too much simulations because you have no idea? And we had to become more harsh on that element within our teams. Also, if someone was doing too many attempts and was proud on having all these attempts. Look how fast I can do calculation. We said, well, if you had any understanding of what you were doing, you wouldn't need that many attempts. So maybe you're on the wrong position. And that's really something that has to adapt. And this is again where that's what I really don't like about presenting hypothetical performances. It's not for nothing that is something within our industry that's a high level within the CFTC rules as well. It has always been easy to do historical hypothetical returns, but it has become more easy the last few years. And the only thing changed over the last 10 years is that it has now been even more accepted by regulators to present hypothetical returns, which is something we as an industry should not embrace.
You mentioned, going back a few moments, the example of the market reaction to the Ukraine breakout of war and how you had these positions in Eastern European currencies that you were offside on, but you had gains elsewhere. So it sounded like you made maybe a discretionary decision not to respond. Is that correct? Is that part of the philosophy? It sounds like it is, that kind of human plus computer is better than computer.
Absolutely. And we've always used discretionary decision. And there was one very important discretionary decision that we took around that time as well. I forgot to mention one currency. We were trading the Russian ruble as well. And you can imagine that we didn't want to continue that. There was absolutely nothing in our system that said we had to stop trading that market. And that's not fundamentally different than in, let's say, 1998, when in Malaysia, Mahatma closed the market for external investors, so we couldn't trade palm oil anymore. That's something that always happened in these environments. So this whole idea the computer does it is not right. In extreme examples, during the credit crisis, getting the trends was not so difficult, but we were trading these currencies with all kinds of banks, and some of these banks didn't want to accept trade from other banks anymore. So, of course, that was the attention there, and that's not systematic. That is using the human skills to do well in that environment. So the human impact, the human input is much larger and has to be much larger than we like to tell often in our industry, because the story, it's computers, it's absolute, it's truth, was selling better than the reality. And even the people that use it the most, I also like Jerry also sometimes like to say that he does nothing like that, but then you hear him 3 sentences saying, and you hear a lot of choices he made. Very good choices. And he's doing well because he made these choices and not his computer doing it. Why does anyone trade which markets? It's a personal decision. It's not a computer saying it. So it's but somehow we think maybe it's kind of technical or just profiling, but we like to say it's nothing to do with computers. We changed it. There is on these this standard questionnaire that says how much of your program is discretionary and how much of it is systematic. And and we used to say it was 100% systematic. But we found out that we could fill in it's 100% systematic as well as 100% discretionary. And we've changed it into that. This, if only because there is no system that we use that we have not discretionary determined we were going to use it.
Well, on that theme, sort of, one of the things that I guess it's been in our industry for a while, there's been a few futile attempts. You referred to something earlier, and without focusing on one specific firm, because there has been many firms doing the same thing, they were starting to say, well, trend is easy, so we're just going to charge you 1% flat fee. That's their decision. That's a business decision, right? But on top of that, in 2022, there was tremendous growth, actually, in CTA replication ETF, in particular in one, the CTA replication CTA, or ETF, sorry. And so I wanted to ask you kind of broadly, I think I know already where you're going in terms of whether you like or dislike replicating CTA strategies, but feel free to talk a little bit about that. But I want to, if you think there is a risk in that, could you talk a little bit about some of the weaknesses that you might see in CTA replication strategies?
Okay, there's two. I think one of them I read their story was they trade only once a week. I think every Friday or something.
It's Monday.
If you
actually,
really
Harold,
believe,
so you need to.
It's Monday. Okay, it's Monday. Well, they didn't trade
That
this
changes
week.
everything, right?
they didn't change trade this week because this Monday only European markets were open. So they have to wait till the US markets for next Monday. Same for Asia, except for Korea. That was open as well on Monday. But it's now. When you're managing really a large size, you cannot do that much in so little time without having a huge impact. So if a few CTAs do so, and if each of them use a different day, the impact is not too large. But as soon as more do it, it doesn't function. So that's one element. As soon as you do it and become sizable, you cannot just trade on one day. It's impossible to do really sizable positions. Yeah, if you want to have an 100 million CTA, okay, but not if you are growing to the size that this is of course also what really hit AQR. They were managing way too much with a style that by assuming no impact, and of course they had an impact. You cannot trade without impact because the markets would not be moving without impact. The market impact by participants trading is the only market impact that makes markets move. So denying this impact is very stupid. So this is one element. Second element, the storyline is that investors want just the CTA return, so the index, and don't want the deviation around it. Which essentially means that you're bringing down the diversification possibilities for an allocator. Isn't it great if you have different CTAs that both are doing well in a kind of environment, but are low correlated? So we have more diversification. So this idea of doing the index is the passive approach, but if you want to do an alternative investment, you want to have a broad space of alternative investments that are different. And the more different they are, the more they offer to your total portfolio. So for the end allocator, and most certainly if it's a large allocator, you don't want that. You shouldn't want that. You want diversification. So you want things to choose from. You should enjoy that different CTAs are doing well.
I understand that, but I think the argument they have, and I have some sympathy for the argument, and that is that many investors don't know which CTA to pick or which 3 CTAs to pick, and so they just want the overall exposure because let's I agree with you that the dispersion of returns have come back to some point, But you could also say to some extent that many trend followers over time deliver the same returns, but not necessarily at the same time. So,
yeah, but okay.
Yeah.
If they do deliver the same return over time, then it doesn't matter which one you choose. Then it doesn't matter which one to choose. Yeah. So it's this idea that you want to get close to an index, and in every time when people wanting to have a low tracking error to whatever is a risk for some. That's not a real market risk, which means that the ones that don't want that risk are paying a risk premium that is available for free for those that don't care about it and carry that risk premium. I think in investment, the only way of making returns in investment ultimately is receiving a risk premium. And if you want to avoid certain risks, which are not real risks, in this case, tracking error is not a real risk, then you're paying a risk premium for that. As simple as it is. So fundamentally, it doesn't make sense.
Yeah. I mean, of course, Transtrend is so big that you're in all of these indices that are now being replicated, of course. That's also an interesting point that there is a lot of concentration. I mean, I agree with you that a lot of people just want the index. We've been taught now that passive investment is better than active and all of that stuff. That's where the money flows. So I can kind of understand why people say, oh yeah, well, let's just do something quote unquote passive in the CTA space as well. And I know you
passive
said
is
you
not
don't
good. I'm completely against passive being good. Passive is bad.
Yes,
and
I know.
Everything in our society, passive is bad.
I think maybe
the only
point
thing
is
that people think if
I was going to say, I think maybe the point is people want greater certainty of getting the return series of managed futures and trend following, and
they don't want to be an outlier.
Yeah,
right?
They don't want to minimize the risk of being in the
industry is up, right?
Yeah. So I think that's the behind the philosophy.
Yeah, but maybe they should realize that costs them money, because if you want to be there where things are happening, you need the outliers. Our world doesn't function without outliers. We need people that make different choices. And if you are an investor and you have enough money to diversify about different things, choose the potential outliers and don't choose the ones that are making no choice at all.
Now, one thing where you could say that having a exposure to many things. So just like we talked before, trend replication or CTA replication, you get exposure to quote unquote many managers in one index. Another area of our industry that seems to be embracing having exposure to many things is, of course, when it comes to the number of markets we trade. And there, I think you're in agreement with many people we've had on the show that trading more markets is better. Now, I've also been saying, and I'm on record for saying, that when I look at the industry returns, if I compare those managers that I know well that trades maybe 50, 60 markets compared to those who trade 200, 300 markets, I really don't see the difference in overall returns. Maybe the returns are different year by year, but overall, long term, they're not really that different because you're going to have to trade smaller and you have many markets and so on and so forth. And you don't have to spend sort of too much time, but kind of what's your overall kind of pros and cons with this fewer liquid markets, but not too few, of course. I mean, so either 50, 60 of the liquid classic market or going much, much broader. Because I think when you and I spoke a few years ago, I seem to remember that you had been on a journey where you really expanded into a lot of markets. But at the time, and this was when we sat down in Miami with Katie Kaminsky, I think you said at the time that you had contracted the number of markets a little bit.
Yeah, we have because the philosophy, the more markets, the better, is not right. And one of the reasons why it became slower and system becomes slower is if you have too many markets that are somehow correlated, you end up, the portfolio as a whole quickly becomes very slow in adapting, picking up new trends and so on. And this is one of the consequences of something that happened over the last decades, that let's say when the credit crisis happened, in fixed income, traders in fixed income and stock markets were completely different. That's why there was a year before, or 1.5 years between the moment that it hit the interest rates and the moment it hit the stock markets. That's not thinkable nowadays. Markets are too much connected now. So what's something happening in one market has an impact on other markets. Also, if it's a nonsense impact, it has an impact. It immediately does. Which means that the way correlation works changes. Also, the way how diversification works is different. So in the past, when these different markets were really doing different, having these different markets in one portfolio automatically went right. Later on, we had to make some more choices to make sure that we really are in different trends, but there can be different trends. Diversification is at the source of what we are doing. That's what we are aiming for. Other trend followers can, let's say, the stop and reverse type of trend followers can have, in essence, a different strategy. And for them, it can be wise to trade just a lower number of the larger markets because you can adapt them easier. For us, it's having maximal diversification is what we are aiming for, in which we don't need to adapt that quick, and that's also why we can hold positions in markets that are less liquid. But in essence, it's another strategy. Diversification is our main thing that we are focusing on instead of being able to stop and reverse. So I think it's also dependent on the style, what effect it has. And yes, we did bring it down because the old way didn't do anymore. We had to adapt a new way of getting invested in different trends. So we now are looking at different trends and try to trade these different trends. But a trend can be, for instance, which stocks are the most yield rise sensitive. We have short positions in those. That's one group of stocks. That's all kinds of stocks in there. That's our trend. And if we want to add to it, we sell some of those. And if we want to size down that position, we buy some of those. And we can choose which one to buy or which ones to sell. That's looking at it from a trend perspective instead of from a market perspective. We are not looking at what is Disney doing. No, we're talking about this trend of which Disney is a part. But Amazon is a part as well. Tesla is part of it. And so it's one trend. And that's the way we are looking at it. And then you can trade these different markets, but you do not need more markets than really needed to get positioned in these different trends.
And can I, before you answer, Harold, can I throw in one more, which is actually a very current example, and that's the recent price cap in Dutch nat gas.
Mm-hmm. Yeah. Okay. I will give you reliability of the market for us is one of the very important elements. So when we are talking Turkey, for instance, we all know that the central bank is not in lead there, but the president is in lead there. Then you have to question whether or not do we trust if money is standing there. Why did we stop trading Russia? Of course, the reliability came down and we didn't want to be positioned in Russian markets anymore. LME, we stopped trading LME completely. We have been trading it for more than 30 years. This exchange completely proved to be completely unreliable. They have to make changes, and we will not trade there anymore if they are not making these necessary changes. Currently, they do not make these changes because the moment they make a change, that will be the point where a law case is going to hit them. So the changes they should make are not being made. So reliability is very, very important. You talked about politicians intervening or central banks intervening. Yeah, but look, the Fed does some things now and then also. And all central banks do. Emission rights, yes. When the price of power gets too high in Europe, then all of a sudden there is more emission rights available. They were somewhere in a closet hidden. So it's part of our world, politicians are part of our world, just like the weather is and other factors that are determining trends, and we have to type of read them. But if it leads to some kind of unreliability, as that we saw in Russia now, and we've seen in the past in some other countries as well, that can be a reason to get away from it, or an exchange that becomes unreliable. We trade futures because we do not want counterparty risk. That's the essence. The counterparty risk is a great system. That's why when the Hunt brothers were in the silver markets in the 80s, yes, they made a mess about it, but everyone at the other side of the trade had no problem with it. We have had this the Norwegian trader in energy markets a few years ago, Ernan Aas or something he was called. Big mess for those markets, but he came down, but no problem. When our friend from Bering was trading in the Nikkei on Singapore exchange, no problem for anyone on the other side of the trade. That's what we like. When that element is going away, when there's this whole idea of counterparty risk, all of a sudden, if someone doesn't like his position and grabs the exchange at his neck, that's wrong. That's fundamentally wrong. So that's something we don't want. So that's when we get out, as we've done with LME.
I'd love to hear your thoughts about capacity, and it's kind of tied a little bit to fees. So here's my observations during the year. Well, first of all, we kind of know that usually returns suffer when strategies become too big. So, I'd love to hear your thought about, generally speaking, a diversified trend following strategy. You mentioned another firm that you felt became too big. Where you're thinking in terms of your own strategy when you think of stopping taking in more money, but also fees, because what I've observed is that a lot of money flowed into the big names from pension funds, and when it came in during the quote unquote CTA winter, some of these pension funds were able to negotiate very low fees because, as we've talked about before, it's just trend. It's so easy, right? Okay, now that trends are coming back and people are realizing, it's not great only to make 1% flat fee when you could make 15% in a performance fee, for example. I have seen some evidence that some of this money is being handed back to these low fee mandates so that you free up some capacity. So I'd love to hear your thoughts about that as well. And I have no idea, of course, what your investor base looked like. So I'm just thinking out loud here.
Okay, well, we have to realize that this is absolutely a capacity constrained strategy. We discussed about it. It becomes even more capacity constrained if you're doing more the same as other CTAs. If 10 CTAs do exactly the same thing, it's one. So, and then the capacity constraint is even much larger. So that's also one important reason for this embracing dispersion, because it also is necessary to do well. All of us can do well if you do more different things at different moments. So that's one element there. During the CTA winter, our amount under management has been coming down as well. So that in that sense, it helped. From a capacity point of view, we will not bring down fees to attract more money, because that doesn't fit with having a capacity constrained strategy. So that this idea offering more and you can we know it's capacity constrained. We are aware of that. That means that if we want to do our best, we think it's worth paying for it, and we can only do that by doing it this way. If we would, let's say, and that is what we often forget, if we would allow an unlimited amount of other investors in for low money, you could say, well, it's the luck for those investors. No, but it's also a negative impact for the existing investors, because the impact on the execution will be on their side as well. Looking at what it means, we've seen over the last years that this tendency of the idea, the spreading idea that liquidity is available for free, has a certain impact on markets, which means that if you are not aware of it, you very quickly become very expensive. So in that sense, if you don't adapt for it, the performance of CTAs becomes even more capacity constrained than it used to be because of all this much more passive money in markets. We have really changed the way we do our business, the way we execute, the way we look at trading, in the sense that it's not the computer says something and traders do it. No, we determine under what conditions we will be willing to buy and under what conditions we will be willing to sell. By doing that, we are much more a liquidity provider instead of a liquidity premium payer. So that's a very crucial element of what we are doing, the choices we make. And that choice made us, we believe that the capacity of our program at this moment is larger than it has been in the past when we did manage above 10 billion. Now we are way below that, but our capacity of the program is larger than it was at that moment because of all the changes we made by being much more trading at different moments and being much more trading in a way that it's in itself less capacity limited.
Okay, no, that's very interesting. You already touched a little bit on liquidity, Alan, so I don't know if I would just jump into the next one and just ask you, because this is a big subject, so I don't necessarily want to go into too much depth. However, ESG is something that I think you've written about it, but also it's something that we all get confronted with, even though it's sometimes hard to fully embrace it as a concept that is very relevant for our strategy, maybe for us as businesses, but our strategy, et cetera, et cetera. And personally, to be completely open about it, I've had my own thoughts about, say, Chinese markets, right? Where I think it's very hard to argue that ESG is being lived up to in that market. Yet there has been certainly, and I don't know if you do it, but there has been certainly a movement towards embracing Chinese futures markets, which probably did quite well for some managers in 2020 or 2021, I can't remember now. But to me, there's this a little bit of a tension between ESG and the market. So what's your view on this? I'm sure you've heard this question
ESG,
before.
I see that the ESG is become a very strange thing. In the European Union, there's even make some rules in which saying that you do ESG becomes a compliance issue because you have to explain on what kind of ways you're doing it. So we have to say we do not do ESG, otherwise we have some compliance issue. But saying we are not doing ESG is at the same time complete nonsense. E is for environment. What's the number one factor that determines prices of agricultural commodities? Too much rain, no rain at all, and so on. That's typical environmental issue. Why have the energy pricing been rising so much in 2021? Europe, no wind, too much rain, no rain. Number one reason for rising energy prices. Even if we would say we only look at prices, then we know that we are long in energy markets because of an environmental issue. So we are trading ESG. Yeah, it must become very, very difficult for a trend following CTA to not be ESG, because that means that all market moves you see, you have to see, this is an environmental move. We do not want to participate in that, so we take that one out. It's almost impossible. So yes, we are in there, and we should be in there, because what it's essentially about is change. And when we are in a big change, for instance, we are in a big change is energy transition, less fossil. Anyone saying that he does not invest in fossil or doesn't want to invest fossil is living in a fairy tale, because we are fossil until deep into our veins. We use plastic everything, and we cannot travel on a plane or whatsoever without using fossils. And I myself have sun panels on my roof, but I know they were produced by using a lot of fossil. So we are completely fossil in everything. But there's a change going on to become less dependent on fossil, and that gives huge risks for everyone involved. If you look at energy, the metal markets, when cars move from become less diesel to more gasoline, you needed less platinum and more palladium, and then it become electric, and then you need more copper. So this is one of the leading trends in metal markets. Futures contracts are not there to invest in copper or to invest in a firm or to invest in wheat. They are there to carry the price risks in these things. We don't buy wheat, no, we are carrying the price risk on wheat. We are carrying the price risk on oil. We are carrying the price risk on a weapon-producing firm or whatsoever. We are carrying the price risk. That's the only thing we do. We have no impact in the sense that we have no control. We cannot say, hey, okay, this hawk is peeing too much, so we let him pee less. No, that's something we cannot do. When you are holding a long position in hawks, we only carry the price risk of that. And when there is change going on, like necessary changes, which is many of these ESG things require a lot of changes in society, this brings huge risks. Futures contracts are ideal for transferring the risk. Returns come from carrying risk and carrying a premium for it. And then you have to trade all these markets that are especially in the center of this whole change. So you have to change coal, you have to change oil, you have to change metal contracts, you have to change all these firms that has to make big changes because that is where the risk has to be carried. So participating in that change is something we do. But we will not call it ESG. We just call it responsible investing.
Let's leave it at that because I know Alan still has a little topic he wants to dive into before we start to wrap up.
Yeah, just one broad topic is, I guess, maybe stepping away and looking at this from the allocator's perspective. So obviously the clients and investors that are coming to you, how would you say to them to think about expected returns? Is it just based on the historical performance, or is there any way that people can say on a forward-looking basis you should expect a certain level of performance or a certain level of Sharpe or what in terms of the types of strategies that you run?
If you mean this question not related to ESG, is it?
No, totally unrelated to ESG, just in general.
No. Okay. Yeah. Now, internally, we just try to control our risk. That is what we do. And the return is the upside that we like to see. But we are never a kind to predict an upside. We hope long term to see an upside.
But if I'm an allocator and I'm looking at traditional investments, long only bond and equities, credit, I'm looking at other hedge funds, I'm looking at private markets, etc., and I'm trying to feed all of this into some kind of asset allocation framework, and they're thinking, well, I understand trend following and I like the kind of properties and the return profile, but I say on a forward-looking basis, 5-year basis, I need to have some kind of sense on what the return profile might be. So I understand what you're saying, that you control the risk and you take the return, but from an allocation perspective, how would you guide somebody?
If you do a long investment in the stock market, you could say, well, historically the stocks have been rising so much percentage, so they will do it again. But that's a complete nonsense prediction. So,
but I mean, say with equities, you can look at the equity yield, or with bonds, you can look at the bond yield. Obviously, with trading markets, you've no kind of intrinsic value to hang your hat on.
No, but let's say the way currency markets or stock markets are traded, you have no intrinsic value. Also, that is linked to the performance that you see from year to year. So this is, I would not give any indication of what you can expect in absolute return type of views. You can only tell in what kind of environments you probably can make money, in what kind of environments you probably not make money, and how that return will be correlated with other type of investments. And so we all know what kind of investment types are sensitive to if the interest rates would rise further. We all know that if stock markets come down, many investors are losing money on them. So it's nice if there are some investments that are different from that. And our CTA program is one of them that is different from that.
So in terms of the role in a multi-asset portfolio, it's an absolute return portfolio diversifier. Yeah. And that's it. And you take what the market gives you. Yeah. No, fair enough. Okay.
Yeah.
And just one follow-up question. I mean, as people have increasingly kind of used trend following within that, as a diversifier, and even for some people in terms of portfolio protection, even to go that far, there's been a suggestion maybe would trend following be better if you didn't have so much equity exposure, and there might be a suggestion you'd be better off capping your equity beta. Have you come across that argument, and what are your thoughts on that?
I've heard that argument, and as a matter of fact, if last year we wouldn't have traded any equity markets, we would have done better. But that's not a very bad, not a very good proof of it. Let's say this whole idea that stocks would be one area and completely not related to the other markets is of course wrong already. What happens in stocks and what happens in bonds is very related. So if you then would say, I don't want stocks, then you should not be wanting bonds either. But then many of things that are happening in commodity markets linked to that as well. So better do it all and be aware that the way of investing, being long, short, finding different trends, how to work them together, is what we're really after. And by bringing down the area of markets that we are trading, we do not do well to the diversification within our strategy. And since diversification is one of the main things for us to be carrying risk, I think diversification is the only thing that is available for free. Kicking out these markets is not a very wise thing, I believe.
Yeah. Well, let me just wrap up with the last couple of questions, Harold. We've taken up lots of your time, and it's a Friday afternoon here in Europe, so we definitely want to make sure that we get you home in time. Now, so this is just like a little fun one, I think, but nevertheless, I'm curious about your answer, and that is, what's the one thing you hear about trend following that you disagree with the most? What are the things people say about trend following where they say, yeah, no, that's completely wrong?
Oh, that whole idea that it's just a factor. That's wrong. Okay. As I said already, it's not a factor.
Nice and short. Okay, final question. Since we're recording just in the first week of January 2023, what are you most excited about for the year? And what are you most concerned about? And feel free to go. I mean, it doesn't have to be specifically about trend following. I mean, it could be anything, really.
Of course, we hope that the situation here, not so far away from our border, Ukraine, Russia, is going to be solved in not too much time, and that is something coming out that will be giving more stability over time. I think that's one of the most important areas. And then, of course, let's hope that now this whole COVID thing is really passing away. China is still a big issue. Many people dying there. That's not something to be welcomed. So let's hope that this is now really moving in a good way. And this is the last area in which the faculties are, what is it called? The victims are there.
Okay, no, fair enough. Excellent. On that note, let's wrap up this fascinating conversation. Harold, thank you so much for being on the podcast and for sharing your thoughts and insights with us. We hope that we can do this again sometime in the future. And to all of you listening today, I hope you were able to take something from today's conversation onto your own investment journey. And if you did, please share these episodes with your friends and colleagues. From Alan and me, thanks so much for listening. We look forward to being back with you in the next episode of Top Traders Unplugged as we continue our deep dive into the CTA industry. And in the meantime, go check out the show notes for this episode and all other resources that you can find on our website. And not least, take care of yourself and take care of each other.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.